Okay, so we are in module 3 of the beginners version. So you were talking about trading platforms. That's what we have at the first area. So trading tools and apps. These are what I listed out here are just your basic day-to-day things that you would use for trading, obviously. So we have the MetaTrader 4 and MetaTrader 5. They are both good for trading, but I would always prefer the MetaTrader 5. When I started off trading, I used to always think that MetaTrader 4 was for beginners and MetaTrader 5 were for pros. But I realized that MetaTrader 5 has always been better because for TradingView is I think it's the world best tool for market analysis. So and TradingView requires strong connection. You get and MetaTrader 5 can pick up with low connection. So MetaTrader 5 gives you that platform to analyze in somewhat a TradingView environment. The way you can move and auto scale and arrange the charts, like it's not as flexible as that on the MetaTrader 4. So I would advise you could pick anyone and dabble within anyone, but I always prefer MetaTrader 5. So we have position size calculator. By now you must have understood the meaning of position size. So how to calculate that to give us the right contract. So it's a tool you use. There's a website for that. So broker specific trading apps. If well you need it maybe if you're trading a live account and you wanted to check your daily loss, daily it wouldn't be something you would want to trade on actually because their charts are a little bit waggy on like MetaTrader 4, 5 and TradingView. You can actually trade on TradingView if your broker is listed on TradingView. So then news websites, of course. There was a time where technical analysts used to focus only on technical analysis and didn't bother much about fundamental. But now, with the way things are going, fundamental is something you want to hold on to as well, no matter the type of trader that you appear to be. So now, what are market orders? So market orders are executed immediately at the current market price. That's what called market orders, right? So let's say you wanted to buy something, it was worth 150 naira. So you bought it at 150 naira, right? That's called a market order. You didn't wait until the price dropped to like 120. You didn't wait on the price that has increased to like 200 before you buy. So market order is at the current price that market is at the current price that at the current price that market is you place your order immediately. So that there are two types. There's the buy market, which is you buy instantly at the ask price. The sell market you sell instantly at the bid price. So, I've explained that whenever you want to buy a market, your orders are triggered at the ask price. Whenever you want to sell, your orders are triggered at the bid price. You must have understood that by now. So now the key point here is fast execution. All right, maybe you don't want to miss a trade. You have a trade rising in momentum, or you're about to enter news. Maybe a news was about to be released, and you were about to say, and you saw your analysis and it fits up so well, and you were about to take the trade. You get unlike pending orders, which will still explain. So it's best used when there's strong momentum, breakout, new trades. You get. Then now pending orders are placed in advance and are triggered only when price reaches a specific level. Like I said, unlike the market orders where you buy instantly at what the price is. If something's being sold for 150, you buy that 150. You don't wait until it's 120 or maybe at a reduced like 200. So in that other part, that's what pending orders are all about. So yeah, it's either you're setting your order below price or above price. You gotta be doing something. So we have two sections of them. We have the limit orders and the stop orders. So now, while trying to read through these limit orders, I want to focus on this image around here by the right. So now, buy limit. Buy limit means that what you buy below the current price. Sell limit means that what you sell above the current price. Now, take note of the trade there. Here is buy, here is sell. So that means this buy limit means that you want to buy. All right. This sell limit also means that you want to sell, but maybe you get no, you're not doing it immediately. So something is configured. So like for buy limit now, you're basically buying below the current price. It's like saying you're saying the market will buy, but it won't buy it. So this is it. You get it's more like a bounce. Maybe the market was coming down. Obviously, the market has to be coming down before your buy limit must have been verified. So the market is coming down. So you are placing the trade below where price is actually it's at where price actually is at the moment. So you are saying that okay, your analysis shows that when a price gets to this point, it's going to bounce off. You get same thing for sell limit. You're selling above the current price, right? So now stop orders means that you're buying above current price. Sell stop means that you're selling below current price. Maybe for buy stop, the market is already rising, right? But you're not sure if you should um place your buy immediately. Maybe because above there, maybe there because there was a strong resistance, and you rather wait for a candle close above the resistance. So you now place your limit at a very high place. So maybe because if you were not with your phone, if market eventually was able to cross that area, it could trigger you in and continue, taking you up. So that's buy stop. Opposite for that is sell stop. So it's used for breakouts or momentums. Maybe there's a news is about to be released. You get, maybe you think it's going to buy. You get, I've seen people use this before. So they praise buy stop and sell stop, maybe because they don't know where the market is going to go. Because news nowadays are not how it used to be 2 years 3 years ago. It used to be very, very volatile, very, very volatile. So they will place buy stop and sell stop. So in case the market, they were saying the market will go down and goes up. You get, so either way they go get triggered, but it's all risky as well. So now we have stop loss. So stop loss is a risk control order that automatically closes your trade when price goes against you. I explained that the only thing you can control in forex market is your risk. That's the only thing you can control. So that means for every trade you place, there's a particular point where the market will go against you, and it will only like take how much you are willing to risk. That's the work of the stop loss. All right. So if you're telling your stop loss that when it gets here, this is when market should take you out, because at this point you are going to lose exactly certain percentage that you said you were willing to risk. So that's what stop loss do. So it protects your capital. It does not like allow the trade to keep going against you forever until it wipes up your entire capital. So it prevents emotional trading. You get, because if you're taking a trade, there must be a place where you, like, if I ever take a trade now, where my stop loss would be is at the place where I know that if price ever comes here, I'm now convinced that my analysis is wrong. You get, so it always makes sense to me. Maybe I'm obviously always trading structure. So if my stop loss is below a previous high or previous low, or below a previous low, any either of them, depending on the structure that I am in at that moment. So and price goes above that and like takes me out and closes above. That's a valid break of structure. Alright. That's a convincing sign that, well, your analysis is wrong. Market is now choosing to go up. Like it's no more going down. Or market is now choosing to go down. It's no longer like rising up. So examples is if you're in a buy trade, your stop loss is placed below, because if you're buying, the only way market will be going against you is if it's selling. If you're selling, the only way market will be going against you is if it's buying. So in a sell trade, your stop loss is placed above the entry price. So if price hits your SL, we call it SL, right? If price hits your SL, the trade closes automatically. Now, take profit. What's take profit? Take profit is a profit target order that automatically closes your trade when price moves in your favor. All right. The financial market is too big for it to owe you anything. All right. We come here every day to take what we can take. All right. So if you always have a target, like I said, I always preach the 1 to 2 rule. 1 to 2. If you can do 1 to 3, that's cool. If you do 1 to 4, that's chill as well. So the purpose of take profit is that it locks in profit. It removes greed. That essentially, again, imagine you didn't use take profit and you were actually seeing double or triple your initial risk. I mean, and you were thinking that market would now give you more when you also had already locked your profit in. Then you now start getting greedy, and market will eventually, most of the time, reverses. You get, we don't say all these things because of bad luck. These are things that somehow have happened in sync over again. Whenever you just break your rules like this, you get punished for it almost immediately. So, example is that in a buy trade, you are buying, your take profit is placed above it. If you're selling in a sell trade, your take profit is placed below. So, if price hits your take profit, your profit is what is secured. You're risking $50, you want to make times two. So, your take profit is at a place that when price gets there, you're making equivalent to times two or more, whichever it is. So, now there are types of charts that we have. We have line charts, bar chart, and candlestick chart. Now there are different charts because I think I don't even know why they were created, but I don't want to call it an involvement of chart representation, but I just know that we have three types. So for line chart, it shows only the closing price. You get a single line connecting prices over time. You cannot use this for analysis. You can only use this if you want to share trend. I use it sometimes when I'm unsure of the structure of the market. You get, because it's just a line, so it will show you how you'll be able to see the structures that you can't see on maybe candlestick pattern and candlestick chart. You'll be able to see clearly on line chart. All right. So the thing is that it has no details, no highs or lows. You can unlike the way candlestick will represent it for you, can see that. So it's also good for beginners. You get and big picture trend direction. The other one we have is bar chart. This bar chart is quite a little bit similar to candlestick chart. It's just that it has no body, and without the body, it does not make sense. If a if a stick does not have a body, you won't know where the true strength lies, right? So what it shows you the open, the high, the low, the close. You get high to the left, low to the tick. It just has its own perfect representation. I think it's a Chinese or a Japan thing, I guess. So more information than line charts, actually true, and used by professional traders as well. But I don't have any friends that use this, but I know that I heard of people who use bar chart. I've seen them on YouTube. So if you're a beginner, it might be a little bit hard for you to read, but if you eventually understand candlestick pattern, you'll be able to like get the scope around it. So it's best for traders who want to do so candlestick, which is actually the main thing, what I always advise. It shows you the open, high, low, close, just like the other one. But the other one does not show you body. The body shows you where the true direction of that market lies. Like how strong. If one candlestick, a candlestick is per time frame. If you're in the 5 minute time frame, so a candlestick takes 5 minutes to form. So you want to know that throughout that 5 minutes, did that market drop intensively? You want to know like how thick the body was. That's what you want to pay attention to. And yes, you want to also know where price has visited, how's the high, the low, and all of that. So it is very visual and easy to read. It shows market psychology and supports candlestick pattern. So candlestick pattern is also a strategy that aids your trading. So it's best for most forex traders. It's best for entries and analysis. That's like the top options of them all. So now time frame. The time frame shows how much time one candle or bar represents on a chart. Like I said before, one candle is equals to one period of time. So if you're the 15 minutes time frame, every candle you're seeing there takes 15 minutes to be completed from open to close. It keeps dabbling up and down until it is finally completed. You get. So then there's so many time frames. We have 1 minute, 5 minutes. There are even seconds actually. But I think on TradingView seconds is for like you have to like get their premium version for that. So there's 1 minute, 5 minutes, 15 minutes, 1 hour. You get various time frames. So that's it. Then types of analysis. Alright, we have three types of analysis actually. We have the fundamental analysis. This one assesses the economical, social, and political factors that may affect a currency supply and demand. Basically, just deals with news, how the economy of a particular country is flowing. You get big investors pay much attention to this. You get knowing what to actually move the market, something coming from the government or so. So people that deal with fundamental analysis, they are called fundamental analysts. Then we have technical analysis. This one focuses on historical price charts and market statistics. They identify pattern. We believe that what has happened in the past will eventually repeat itself. All right. So technical analysis is nice to be honest, and these people are called technical analysts. Then the last one is sentimental analysis. This is more like so I call it like a survey. Is you gauge it like when you're like assessing the emotion and like the trading decisions of other traders. Combining how many people are buying this market, how many people are selling this market. Just it's people that are called sentimental analysts, and it's not something that I'm doing. Like you can actually ask your trader friends that what's the idea on a particular pair, but always basing your entire trade on whatever they say is not like I do. So I always advise have good taste of being a technical analyst and a fundamental analyst. So now types of traders. We have four types of traders. We have the position traders, the swing traders, day traders, and scalpers. So position traders, these are the big investors of the market. All right, these are the people that will take a trade and hold that position for like months, even years. You get imagine someone taking a trade by January and his profit is by like December. This same trading that somebody is withdrawing like 330K in a day. You get so demands a huge amount of patience. It's just basically people that don't see trading as people just see trading as a just investors that see trading as another way to grow their money, not their main source of income. They're mostly the ones called position traders. Again. So swing traders, people, similar to position traders, but they just basically hold trades for like few days, you get, or weeks, you get, not like a year. You get they also hold trades for long, you get they can like Maybe someone took a trade on Monday and it's take profits maybe before it hits its target. That would be like maybe Friday. So those are swing traders. Then day trader, I'm a day trader. So we open and close positions within a single trading day. So if I open a trade by 8, I have to like close it before, at least before the next trading day, if not before the end of New York session. So it's only on few occasions that I have my trade running over to the next day. Only on few occasions. Why scalpers? This one they focus on making small frequent profits. Right? They're always up. Small 5 pip move, 10 pip move is very very important to them. So they're always on the chart and they can't be away because they have to like catch this move, and it's always a very tight spot to be a scalper, but people are still good at it. All right, that's the end of the slide.